Okay, I appreciate the feedback on the slideshow. I'm going to make sure that the right slideshow is up here. Okay, if you could just confirm that proper money management is the slide that you see, I would appreciate that. Okay, great. Thank you for doing that. And so we will continue and progress here through proper money management. We've basically just gone through the disclaimer, and we've just asked this question here about leverage, and multiple people responded with E, which is the right answer. Leverage is many things to traders, many different things to traders. It really depends on what side of the market you're on, initially in terms of how you do in the early days of trading. And that's why, a lot of times traders will come into an account and say, wow, I heard that I could trade at 400 to 1 leverage. And, even if somebody has traded the other markets before, like the stock market or the futures market, and have years of experience in those markets, those traders also have never traded on 400 to 1 leverage. So it's a concept that really can only be fully grasped when you have real funds in the market. Now, what I will say about leverage is that what makes it attractive is it does allow for you to come into the market with a relatively small amount of funds, okay, compared to if you went into, let's say, the futures market. If you have an opinion, Aura FX also offers CFDs besides the FX pairs on products like oil, gold, silver, copper. If you like to look at those commodities, if you're forming opinions about those commodities, certainly there's a lot of new oil experts all of a sudden since about a year ago when oil started plummeting. Oil is not just in the front page of the financial headlines. It's front page news in our daily newspaper because oil affects everybody, right? So you can actually trade those instruments with leverage in what we call a CFD or a contract for difference. But a lot of futures traders who traded those same products years ago and still do today can only really leverage as high as 2 to 1. So that's why this is really a learning experience for everybody, new and old in the markets. So what exact margin deposit do I need for each leverage level? Now, this isn't a poll question. This is just kind of spelling some information out for you because this is one of our most common questions that we receive, particularly after somebody opens a live account. This becomes very pertinent very quickly. So if I'm trading on 50 to 1 leverage, what is my margin level? And as we just said, trading with leverage is another way of saying I'm trading on margin. Margin basically you can think of as collateral, okay? It's a deposit that you're putting down, okay, to hold that larger position. A good example is a mortgage on a house, right? You're putting down a certain amount to hold the position, right? It's a little different here in the sense that when you close the trade, right? So margin is not a cost. Many times in the beginning, traders will confuse margin and spread. Okay, spread is the transaction cost of the trade. That's the difference between the buy and sell price. You pay that when you get into the trade, and it's said and done, right? But what you're also doing when you get into that trade is you're putting down margin. And in a mini contract, each mini contract, again, is 10,000 units of currency. So imagine for a second that you had no leverage afforded to you at all in the market, right? If you had no leverage afforded to you at all, that basically means to open up a 10,000 unit contract, right, which is a mini contract, you would need to have at least $10,000 in your account because you're not being given any leverage. And that might be even the easiest way to understand it. With no leverage, at a bare minimum, you would have to have an account equal to the size of one contract to even get involved, right? And in fact, in reality, you would need much more than that because with a $10,000 account, trading a $10,000 contract, and you try to open that, you're completely over leveraged, right? Because you have no room at all for the market to move against you or float against you because you have zero what we call usable margin. So in reality, if you were trading at 1 to 1 leverage or 2 to 1 leverage in the FX market, you'd have to start with $50,000 to $100,000 at a minimum to get going, and that's where the leverage is attractive because you can start an account with $1,000, trade the same 10,000 unit contracts because you have that leverage there. So getting back to this current slide, 50 to 1 leverage is another way of saying you're trading on 2% margin. right? You're putting down 2% of that $10,000, 2% of the contract, okay? And whenever you close that trade, that 2% margin will be returned to you, okay, regardless of how that trade is closed. Now, that 2% for in the case of a mini contract, which we're using mini contracts here in most of these slides because that is the most popular traded contract with Aura FX. Some people do trade the standards and some people do trade the micros, but mini is the most popular, so we're using that for today. 2% margin is $200 per mini contract. Okay, 200 to 1 leverage, which is now you're going up a higher level of you're levering higher. Okay, that's 0.5% margin, which equates to $50 per mini contract, right? 0.5% of 10,000 is $50. You can do the math. It's very straightforward. 400 to 1 leverage, which is the most common setting for at least a new account holder who's getting started, is 0.25% margin and $25 per mini contract. Now, I say most common with a smaller account. Really, when we open accounts, another common question we get is, how much should I start an account with? Fair question, especially if you've never been in the markets before. It's tough to really get a grasp of that. Our opinion is that $2,000 at a minimum is really the way to go there, so that you're not depending on 400 to 1 leverage to allow you to take a larger position in the market, or not even a larger position. But let's say you had an opinion about the euro US dollar, which had a big day today, right? Some of you might have been looking, if you looked at the market, you saw that the euro US dollar broke below 110, right? Big day. And you might also be looking at the US dollar, Canadian dollar, which has also had some big moves recently and probably has more in store. So with that being the case, now you have two currency pairs that you have an opinion on. Let's say alone you want to trade one lot each. That alone is a 20,000 units of currency that you have in the market. So you're already naturally leveraging yourself higher with the more positions that you take. And this is something that traders forget. You are leveraging yourself higher the more trades that you take. It's not just what your leverage setting is at in the account. So these are numbers that you probably want to remember. We will be sending out the slides afterwards, so it's not something you need to write down. We will get these to you, but it's just good to keep in mind. And trust me, like I said earlier, once you start trading with real funds, if you aren't already, you'll come to know these numbers like the back of your hand. So talking about account balances again, because that's really what this centers around. The two key aspects of maintaining our account and protecting our account balance, which all of us have spoken about, Greg, Tom, and myself, is it comes down to what you're starting with in the account, right? Whenever we open an account, what's going through our minds, right? Well, I can tell you in conversations with a lot of our clients, what's going through their minds is, okay, I'm putting in $2,000, and they're already fast forwarding in their mind, okay, where is this account going to be? What's the balance going to be a month from now, right? That's kind of human nature, right? I think, it'd be hard pressed to meet somebody who opens an account and that thought doesn't cross their mind because they're excited, right? We're doing this to return a profit. That's the goal. Of course, we understand the downside risk, but we're always thinking about what type of return can I get? And if I get that return, what will my account be standing at 1 month from now, 6 months from now, and so on? So how well you actually do, though, doesn't just come down to how right you are with your calls on your trades and the positions that you're actually taking. And that sometimes becomes a fixation on that fixation on being right, which Tom spoke at length about yesterday. Whether you're in the game 6 months from now or not, and many times is not going to come down to how often you're right about the trades that you're taking. We're all going to be wrong. In many cases, many of us are going to be wrong. Most of us will be wrong many times. That's accepting that losses will occur is a big part of winning overall. The sooner that we gain that acceptance, the better off you will be as a trader. And sometimes there's things in the market. Or this system hasn't lost a trade in 5 months. Whether that's true or untrue isn't really the point. It's a matter of it's almost propaganda in the trading world, propaganda to make you think that that should be the measure of your performance, right? That we should be measuring our performance as traders based on winning percentage. And it's easy to let that distract us because in most other walks of life, especially in the educational realm, which all of us have gone through for many years, that is the measure of our performance. Okay, I am trying to win 95%, or if I can't win 95%, I want to at least win 90%. And well, if that doesn't happen, then I really, really don't want to go any lower than 85% because everything I've done in my life, if I'm under 85%, that means I'm mediocre. You know, and if I'm under 85%, if I'm under 80%, well, now I'm a C student. You know, and if I go any lower than that, now I'm looking. You know, these are D and F grades, right? That's in the educational world. We're not in that world. We're in the world. Our goal here is to make money and to make money consistently while limiting our downside risk. And winning percentage does not equate to making money consistently, right? Of course, it goes without saying on any given month, we would all love to win the highest percentage we possibly can. We would all love to have a 95% winning percentage in any given month. And hey, you know, we maybe, you know, sometimes we will have those months. Some traders have seen that here early in 2015 with the way that the markets have been trending so strongly. But that should not be over the long term the measure of our performance, because you're almost setting yourself up for failure when you do it that way, because you're bound to have a letdown. You're bound to have a month where your winning percentage is far, far less than 90%. It's going to be sub 50%, and you're in many ways getting down on yourself for all the wrong reasons. You know, it's not the measuring stick of how you're going to be doing in the long term. And so, how much you start with in the account does impact that. You know, you want to come out the gate as well prepared as you can when you're trading the markets. And if you kind of look at it like a sport. You know, I use a lot of sports analogies. You know, somebody going into the boxing ring, you know, like Muhammad Ali used to say, he didn't win his fights in the ring. You know, he won his fights, you know, in the 6 months leading up to the fight, well before he got under the bright lights, right? You know, some of us have heard that quote. And in trading, it's similar. You know, it's not a boxing match, but the reality is what you bring into the market and your knowledge of the market and specifically your knowledge of leverage. If you have a very strong grasp of it, you're coming into the market empowered. You're coming into the market as finely tuned as you really can be when it comes to money management. And your account balance affects that. So certainly you can start an account with $100, $300. Many clients like to start small, just dip their toe in the water, and that's fine. But the reality is your balance will affect your performance, and more so than your performance, your mentality, because you'll start to grasp that if your balance is too low, given the trades that you're taking, you will be over leveraged. And so these are just guidelines, general ideas for where you might want to start based on how leveraged you are. So at 50 to 1, we recommend having at least 5,000 in there. Okay, placing 1 to 2 lots at a time. 200 to 1, 2,000, and at 400 to 1, 500. Those are just minimum guidelines. Okay, I'm just going to take a quick look back here. Okay, I'm just checking the chat. Can everybody still hear me? Okay, I'll pull up the current slide. I apologize if the slides aren't showing clearly for some reason. Okay, let me just pull up the slides. Just bear with me 1 second. Okay, the slides are showing on my screen, so that's interesting. Just bear with me 1 second. Okay, well, I do see that it's recording properly, so we are just about near the end. So these are really just concepts. So if you've noted the points, it's really, with leverage, we're not looking at the platform, so hopefully that you're grasping the concepts here. And the next slide, really, just if you can't see it, is a poll question, which we can answer together, which is, do you use stops and limits in your trading? And so if anybody wants to go ahead and answer that, feel free. And we'll get into why we're asking that question. Okay, so one person says yes, one other person says always. Fantastic. Steve says I would, so it sounds like you're still just getting into it and anticipating what you would do. And then I have a poll question here to follow up, which is if I start an account with $2,000, right, which is that balance that we really suggest starting with if you're going to be up at something like 200 to 1 leverage, okay, or higher. If I start an account with $2,000 and I use, so I follow, the advice that I think is right, and I use stops and limits, what will my account balance likely be in 6 months' time? That's the question. And I know that you can't see it, so I'll type it, or in some cases it seems like people can't see the slides, unfortunately. So what I will do is type the options into the chat room. Timmy's laughing because she's saying 0. Okay. Hopefully not 0. But if I start an account with $2,000, which I'm typing in here, so this is my starting balance, will I, after 6 months, have will it remain at $2,000? Will it be at $4,000? So will I have twice as much? Will I have $3,000? Or will I have $1,500? So which of those seems the most likely to you? And we can have Timmy's example of 0 if we want, just for a good laugh. So Junie says 3,000. That's interesting. Anybody just have any other thoughts there? Okay, Jeff says D 1,500. Jeff might be the realist in the group, perhaps. Okay. So it's kind of a trick question because Timmy, you took the words out of my mouth, or so pretty much, which is any of those actually is possible, right? But if you notice, the common theme among all of the answers is that none of the answers is 0, right? Only Timmy initially had the 0 response, but in the selections here, none of the choices were 0. And if you go back to the question asked, if I'm using stops and my limits on every trade, what will my account balance be likely after 6 months? And the point we're driving home here is that stops and limits will not guarantee profitability, right? That's not what they're there to do. They're not there to guarantee that you profit on every trade. They're there to ensure that your account balance is protected. And yes, having as Steve said, expecting to get 4,000, that's definitely within the realm of possibility, especially if, as was hit upon quite a bit yesterday, okay, you're using reward to risk ratios that are positive, like 2 to 1, right? And that's why, for those of you who might have been in the markets for the past few months, I've talked to more string of profitable traders in the past few months than I have since I can't remember, particularly because I'm speaking to traders who are using reward to risk ratios, and because the markets are trending as strongly as they have been, a lot of people are doing well right now, especially if they're, and this is the that's what the markets can really reward you in certain times when you abide by the money management guidelines that you hear all the time. Sometimes they won't, you won't find necessarily that there'll be a windfall of we can't always have a windfall of profits. We can't always turn 2,000 into 4,000, but I will say that given the right market conditions, given that your identification of the market conditions are there and the trends are strong, you know, the outlook can be extremely rosy during certain stretches of the year. You know, and as Greg hit upon in our previous webinar, and was hit upon yesterday as well, you know, you don't need to be trading all the time. You don't need to be trading for the sake of placing a trade. And what we help you do is identify the times that you should be trading based on, you know, what you intend to do in the market, what your starting balance is, what time zone you're in, all these things. We care about those things because that will help identify how you go about maximizing the odds. But in these 4 examples, we're saying that really, in the case where I'm losing money, I'm not losing my shirt, right? I'm drawing down on my account basically $500 in this case. In the case of the deselection of $1,500, I'm drawing down on my account, but I'm not losing my shirt because I'm managing. I know that with my 2-to-1 reward to risk ratio, yes, my account might be down 6 months from now, but it won't be 0, right? And that's really the key. We want to live to fight another day. You know, I can tell you it's you know, it's traders who aren't in the markets very long for days or weeks. This is usually the reason why. It's because in some way, shape, or form, they're over leveraging themselves, or they're not protecting their account balance in the way that they just lose sight of that because we become overly fixated. You know, it happens even with years under your belt because, you know, when markets start moving, you get excited. There's, you know, non-farm payrolls. You know, prime examples tomorrow. Non-farm payrolls is coming out tomorrow. You know, I know a group of traders who love to place bets on where's it going to come out, and that's almost like another way for them to make money. It's like, oh, well, you know, whoever comes closer to the actual number gets, you know, X amount of dollars that they're betting in the pool, right? The very last thing they think about before getting into the trade is, oh wait, where do I want to put my stop, right? It's kind of, it all too easily can become an afterthought. You know, because there's so much more interesting things to talk about. You know, are there going to be 250,000 jobs going to be created in the U.S., or is it going to come in way under? Is it going to like miss expectations completely? You know, how big of a trade? How much do I want to make on this guy? Like, can I make $500 tomorrow? Like, is that possible? Can I do it? Right? And then finally, we get to the thought of, okay, so what am I willing to risk? Right? And as Tom said in his webinars yesterday, that should be the professional traders who are in the game for a long time. That's the first thought that goes through their head, not the last thought that goes through your head. And sometimes, you know, it takes having a few losses that sting you a little bit to really kind of identify that. So good job there. Thank you for responding to those poll questions. Much appreciated. We are pretty much at the end of this webinar with regards to leverage. I think you know, this point has been driven home, and I'm sure in the subsequent webinars here today it will continue. If there are any other questions on this particular topic, money management, please type them into the chat room because we do have, you know, just under about 10 more minutes than intended. Any other questions regarding position sizes, balances? You know, this is all around this concept of money management. Yeah, Steve says discipline is the main core for money management. That's so true, you know, and you know, some of us are quite disciplined, you know, from our other, you know, what we did before we came into trading. You know, some of us find discipline comes easier than others. You know, and that's why, you know, and even for the most disciplined person, having a mentor, having a coach, you know, even having a sounding board to talk to other people, your peers in the market. You know, I work with analysts who have decades more experience than I do in the markets, and I observe them, you know, bouncing ideas off of each other about the markets because, you know, what's that like old, you know, phrase where, you know, two men keep each other sharper than one man alone. You know, you're basically like sharpening swords on each other. You know, that's, and in trading that's true too, because it's, you know, you never stop learning. And, you know, that's really one of the benefits of at Aura FX, like Greg said before his webinar. You know, the years of experience that you have here at Aura with the team and the background, you know, that will help keep you disciplined in the absence while you are acquiring your own discipline, especially for you new guys out there, and take advantage of that. It's hard to find. And so I will give one more quick mention about the raffle. Okay, it's at the end of the day today. I know for some of you the time zones, at the end of the 7th session, it might be quite late wherever you are, but it is out there. If you happen to not be in the session at the time, we will. I think that was the case for yesterday's winner. But we will certainly keep note of it. But that is coming after our 7th session today. Just to keep track, this is the 2nd session, so quite a few more. And once we get we will get a series of emails after the boot camp, and we always appreciate your feedback. We certainly have gotten a lot of it here just up to this point, and we've taken note of it. But afterwards, if you reply to any of our emails and give us further feedback, you will get that $50 to start trading in accounts with Aura FX, which will be a fantastic starting point. Okay, so we'll call it here. We're about 20 minutes from the start of the next webinar. I'll just double check to make sure there are no more questions. John also agrees with Steve. Money the core, discipline the box it's in. Yes, exactly. And what we will do regarding the slideshow, John, is we have everything recorded. So it's basically 12 webinars in total between yesterday and today. So for those of you who happen to not be here yesterday, okay, it's 12 webinars between yesterday and today, and those will be sent out post-webinar. So more to come on that today at the tail end. I will just give a recap of what's coming, so nobody's in the dark. But you rest assured, those emails will come through, and you'll have a lot to go through after today's session. So we will brief you further, but keep the questions coming. We really enjoy answering them. So why don't we all just take a quick break well, this will be probably one of our longer breaks, but you had a very short one after the last webinar, so feel free to grab a cup of coffee, quick bite to eat, whatever is going to get you prepared for 5 more sessions. So you might want to put something in the tank to keep you up for 5 more sessions. So, and up next is Tom Long with top 10 technical indicators. So now we're going to get a little bit more into the nitty-gritty of technical analysis. Okay, those of you who are still boning up on your technical analysis, this is a fantastic webinar for you to make sure that you stay on top of. So with that, I'll leave you guys go until we reconvene again at the top of the hour. Thanks a lot.